How candlestick charts work and what time frame to choose. Welcome to the fourth lesson of the Forex Basics Course. In this lesson, you will learn what the most common types of charts are, how to read a Japanese candlestick chart, what time frame to choose to understand market movements better and make more realistic forecasts. Types of charts. There are two basic types of charts available in Forex, line and Japanese candlestick. Let's look closer at both of them. Line charts. Line charts are the simplest. They only connect closing prices over a given time period and depict the general price trend. You can use this type of chart as an overlay or for comparing charts when performing an intermarket analysis. For example, you might compare the prices of the Australian dollar and gold using a line chart. Candlestick charts. Japanese candlesticks offer the most popular form of charting. The candlestick bears much more information than the line chart, and it is represented in an easy-to-grasp visual form. The body marks the area between the open and closed price. If the price closes above the open, the body is hollow. The hollow candle is referred to as white, and the solid candle is called black, though in reality the chart can be shown in any color. If the price ends up closing lower, the body is solid. The narrow line, called a shadow, shows the price range for the set time period. One Japanese candlestick is basically a linear chart representing the price for a selected time frame, but shown in a more compact form. Take a look at how a linear chart that represents a growing price converts into a white Japanese 5-minute candle. Now this is how a linear chart that represents a falling price converts into a black Japanese 5-minute candle. What time frame to choose for the chart? Traders use monthly, weekly, daily, 4-hour, hourly, 15-minute and 1-minute time frames. Ideally, traders pick the main time frame they're interested in and then choose a longer and a shorter time frame to complement the main one. The longer time frames typically contain fewer and more reliable signals. The shorter time frames usually contain more signals with less accuracy. There are several types of traders and they have different trading styles. Swing or position traders prefer holding trades for days or weeks. They mainly focus on the daily charts for their trades. They can also make use of weekly charts when defining the long-term trend, as you can see on the example. They track a 4-hour chart when defining an immediate short-term trend. Intraday traders who enter and exit the market the same day pay more attention to shorter timeframes, such as the hourly and 4-hour charts for entry signals and the daily chart for the broader trend. Let's summarize what we've learned from this lesson. You can use the line chart to make an intermarket analysis, but to analyze the price of the symbol you're trading, you should use the candle chart. The candles can be of two colors, white, bluish, where the closing price is higher than the opening price, and black, bearish, where the closing price is lower than the opening price. Use bigger time frames to find stronger support and resistance lines or a trend, and smaller ones to make your final decision. In this lesson, you will learn about the remuneration that brokers charge for their services and how the spread is related to it, the swap and how to avoid paying it when you trade overnight, tricks dishonest brokers use, and what fees you don't need to pay.